So we started weighted average cost of capital in our last class. And we said that weighted average cost of capital represents the overall cost of capital for a firm, weighted according to the proportion of each source of finance in a company's total pool of capital. Okay. And we also said that there are basically, of course, we know already the categories of weighted average cost of capital, which is traditional weighted average cost of capital, the weighted average cost of capital of the combined activity, then the project specific weighted average cost of capital. So, but when we discussed the WACC last time, I mentioned to you that there are two methods of calculating traditional WACC. You can either use market value method or you use the book value method. And I mentioned that the market value method represents the market value represents the price determined by the market forces of demand and supply, and it is the most acceptable by the market participants. All right. And at all time, you are expected to use market value to compute your weighted average cost of capital. So at times, examiner may be specific by telling you that you should use uh, book value or market value. But where examiner is silent at all time, you have to use the market value. Book value is the price. I mean, is the book is the price as shown in the balance sheet of a company. So book value is the same thing as nominal value or face value. So that is an historical price or historical value for that matter, and that's why it's mostly it doesn't take into consideration the market information. So, and as a result, it's not really acceptable by by investors. Okay, so whenever the most important thing is that whenever you want to calculate the weighted average cost of capital, you are expected to use the market value to get the proportion of equity, preference share, and then debt capital in the company's total pool of capital in order to get your WACC. Okay, so that is what we discussed last time, and I believe I gave you the formula that you can use to compute the cost of, weighted average cost of capital. So, and I gave you the formula, and I also gave you the tabular method that you can use. So whichever of the two that you are going to get the same answer. But we were unable to solve an illustration. And I mentioned that today, all what we're going to be doing are just calculations. So if you missed the first two classes, of course, the recording is there. You would have recovered that. Even at that, when we are calculating, when we are solving question under WACC, we are still going to be referencing all those things that we did under cost of equity, cost of preference share, and then the cost of debt. So quickly, let's have illustration. Okay, let's have illustration. And then again, please always ask question. When you have any question to ask, just raise your hand. And even if your question relates to the past classes that we have had, I can always respond to your queries. Very important. All right. Okay then. So let's have illustration. Let's start small. Let's start small. So let's start with this illustration number 11. Okay. I will read for you. The account of Ostra PLC reveals the following capital structure. Okay. So like I mentioned, capital structure represents the way and manner a company finances its operation. So Ostra PLC finances operation through ordinary share capital and then debenture. Okay. So market value of the above shares is as follows. Ordinary 3 naira 75 kobo ex-div, debenture stock 80 kobo, sorry, 80 naira. The cost of equity is estimated to be 20%. Examiner has made life easy for us by giving us the cost of equity, so no need to stress yourself on that. The cost of debt is 7.5% after tax. Therefore, what is the weighted average cost of capital using the book value and then the market value? The essence of this question is to demonstrate for you how to calculate weighted average cost of capital using book value and then the market value. I told you last time that whenever you want to calculate weighted average cost of capital using book value, you are expected to add together the ordinary share capital plus reserve. Okay, you add together the ordinary share capital plus reserve to form the proportion of equity. Okay, to form the proportion of equity, you are expected to add ordinary share capital plus reserve. You only do that whenever you are using the book value, whenever you are using book value method to calculate the weighted average cost of capital. All right, so that is only when you add ordinary share capital plus reserve. So watch out for that. Okay. Sorry. My phone is not connecting. What's happening? Oh, okay. Back. Book value. All right. So quickly, let's solve the question. I will switch to the working note. All right. And then again, one more important thing you need to take into consideration is that whenever you want to use the market value, you need to first of all go and compute the market value of each source of finance. What is the market value of equity? What's the market value of preference share? What's the market value of debt? You keep it somewhere. Then you now begin, once you now want to calculate your work, then you are going to use the market value. So to form the proportion of equity and other source of finance in the capital structure. And then not only that, okay, so you can decide to either use formula or you use the tabular method to calculate your work. Whichever one that is more convenient for you is what you should do. Okay, but again, when we get to project specific and the wakuka, whereas all what we're going to be using are just the formula. We don't use the tabular method to calculate work when we get there. And not only that, please, you must be very careful. Whenever you want to calculate your market value, you must ensure that you are using the ex-div share price or ex-int price. Okay, it is very important. Okay, so because this particular question is very straightforward and of course, nothing to sweat about. Okay. Let me know if you can see my screen, please.
Yes, we can see the working page.
Okay. Okay, thank you. So the name of this company is Astra PLC. So I would then say calculating weighted average cost of capital, denoted as KW. So it's the same formula that you're going to use all through. So I can say WACC is calculated as equity value over equity plus debt, because there's no preference share, multiplied by cost of equity plus debt value, equity plus debt, cost of debt, 1 minus tax. Okay, so that is the formula for calculating weighted average cost of capital. So examiner is asking us that we should use book value and then 2, market value. So I can then say number 1, using book value. I don't know what happened to my pen. It's not writing well. Okay. So I can then say KW equal to, using book value. I know that when I want to calculate WACC using book value, I'm supposed to add together ordinary share capital plus reserve. So I will then go to the balance sheet as given to us. What is ordinary share capital? Ordinary share capital is 2 million naira. Reserve is 3 million naira. So the proportion of equity is 5 million. So 2 plus 3 divided by total value 6 million multiplied by cost of equity of 20% as given to us plus the value of the debenture is 1 million naira over total value of 6 million naira multiplied by cost of debenture of 7.5%. So that 7.5% is already after tax. So there is no need for me to come and to go and do 1 minus tax. So because examiner has told us that the 7.5% is after tax. Okay. Therefore, I will then say KW equal to 5 divided by 6. Okay. 5 divided by 6 equal multiply by 20 equal, that's 16.67. From the left, it is 16.67% plus 7.5, okay? 7.5 divided by 6, that's 1.25, 1.25%. So when you add the two together, plus 16.67, that's 17.92. Our work equal to 17.92%. So you can say approximately the work is equal to 18% using book value. So using book value, this is how to calculate your work. This is how to calculate your work. So all you need to do is to add together the ordinary share capital plus the reserve. Then number 2, using market value. I don't know what happened to my pen. It's not writing well. Using market value. Okay. So I will then go to the question. I need to go and calculate market value of equity and the market value of the venture. So I will move, here will be my working number 1, market value. Okay. So market value of equity. Before I put down the formula that I'm going to write and I'm going to use, I need to go back to the question and check if I'm given ordinary share capital or share, I'm given number of shares. So in the question, I'm not given number of shares, I'm given share capital. Therefore, my formula will then be share capital divided by nominal price multiplied by XDIV, share price. Okay. Yes, you have to manage my handwriting tonight. I don't know what happened to my pen. It's not writing well. I think the points is broken. So I need to fix that later on. Okay. So market value of equity is equal to 2 million. Please, when you are using market value, you don't have ordinary, you don't have book value. Sorry, you don't have reserve. Okay, please. It is only when you are using book value that you had reserve to your ordinary share capital. When you are using market value, you don't do that. Share capital is 2 million. The nominal price is 1 naira. Ex-div share price is 3 naira 75 kobo. So what do you have here? Please bring out your calculator and be giving me the number. So 2 million multiplied by 3.75, 7.5 million. 7,500,000 is the market value of equity. I need to calculate market value of the debenture. To get the market value of the debenture is the nominal value multiplied by X int price. Again, you have to ensure that the interest expense has been paid. You have to ensure that the interest expense has been paid before you calculate the market value of the debenture or of the debt. So if the interest has not been paid, you need to make adjustment because you have to use the X int price. If you are given a cum int price, you need to convert it to X int price. So divided by 100 naira. Okay. So market value of the debenture. I will then go back to the question. The nominal value of the debenture is 1 million naira. Multiplied by X int price is 80 naira. Divided by 100 naira. This is equal to 800,000. So the market value of the debenture is 800,000. So I need to get the total market value, which is value of equity plus value of debt. Value of equity is 7.5 million plus value of debt of 800,000. That's 8.3 million naira. The total market value is 8.3 million naira. So I will then come here. Market value of equity. E, we are using the same formula. E is 7.5 million. So here is 7,500,000 divided by total value of 8.3 million. Multiplied by cost of equity as given to us 20%. Okay, plus the market value of the debenture is 800,000 divided by total market value of 8.3 multiplied by after-tax cost of debt, 7.5%. Okay, so KW equal to 75 divided by 8.3 equal, then multiply by 20 equal 18.07% plus the other side, which is 800 divided by 83 equal multiplied by 7.5. That's 0.72, 0.72%. So when you add the two together, 18.07 plus 0.72, that's 18.79. 18.79%. So approximately using market value, WACC is equal to 19%. So that is how to calculate weighted average cost of capital using book value and then market value. Let me know if you have any question for me before we move to the next illustration. All right. Any questions so far? If there's no question, let's move to another illustration. Okay. Let's try illustration number 12. Illustration number 12. I need one of you to read for us. Who will take the lead? Somebody should read for us, please. Yes. Who is reading? Okay, let me call one of you.
Okay, I'll read, sir.
Okay, thank you, Wumi. Go ahead.
Okay. The management of Abakaliki PLC has tried to decide on a cost of capital to apply of the evaluation investment project. The company has issued share capital of 500,000 ordinary share of 1 naira current. Sorry, I'm not saying the extreme. Okay, currently quoted at 1 naira 17 kobo per share cum div. It has also issued 200,000 naira of 10% debenture, which are redeemable as par in 2 years' time and have a current market value of 105.3% and 100,000 naira of 6% preference shares currently quoted at 40 kobo per share. The preference share dividend has just been paid, and the ordinary dividend and debenture interest are due to be paid in the near future. The ordinary share dividend will be 60,000 naira this year, and the directors have publicized their view that earnings and dividend will increase by 5% a year into indefinite future. The fixed assets and working capital of the company are financed by the following. We have ordinary share of 1 naira each, 500,000 naira, 6% preference share of 1 naira, 100,000 naira, debentures 200,000 naira, reserves 380,000, total of 1,180,000 naira. Can you scroll up, please? Okay, the company tax rate is 40%. Required. Advise the management of Abakaliki PLC on the appropriate cost of capital to use for its investment.
All right, thank you very much, Wumi. Um, I believe Oda could hear her when she was reading. I think my network is fluctuating here. But yes, the question is asking us to advise the management of Abakaliki PLC on the appropriate cost of capital to use for his investment opportunity. And then, of course, this is a very straightforward question, but if you don't understand the underlying principle, certainly you are going to struggle no matter how simple it is. So in this particular question, examiner wants to test your understanding on how to treat cum-div share price. Not only that, examiner also wants to test your understanding on how to incorporate growth in calculating cost of equity. Not only that, when the interest expense has not been paid, how do you treat it when you are calculating your work? These are some of the things that examiner want to test your understanding in this question. So it's very clear from the requirements that we are to calculate appropriate cost of capital. At this point, you need to ask yourself, what kind of cost of capital? Is it cost of capital using traditional work? Is it cost of capital using project specific? Is it cost of capital using Wakoka? So you need to know which of them that you want to calculate at the appropriate time. As far as this question is concerned, I mentioned to you that whenever you are given information on capital structure, okay, this is what is called capital structure, the way a company finances its operation. So when you are given capital structural information, you are expected to use the traditional work to compute your weighted average cost of capital. So if that is the case, you want to calculate traditional work. I told you there are 4 procedures you are expected to carry out depending on the nature, depending on the capital structure. If you have in the capital structure, you have ordinary share capital, you have preference share capital, you have debt capital. In that case, you are going to carry out 4 procedures for you to be able to estimate your traditional WACC, meaning that you are expected to calculate cost of equity, you calculate cost of preference share, you calculate cost of debt, then you calculate weighted average cost of capital. Those are the 4 procedures that you are going to carry out. So each of them has its underlying way or methods of computing it. And I said that when you want to calculate cost of equity, you need to ascertain from the question what kind of cost of which method do you want to use? Is it cost of equity using dividend valuation model? Is it cost of equity using capital asset pricing model? Or is it cost of equity using Miller and Modigliani? The question will tell you which of the methods to use because it is implied. The information will be supplied. The information will be given to you in the question. So that will be directing you into which of the methods that you are supposed to use. Okay, but without wasting time, as far as this question is concerned, first thing first, I want to calculate cost of equity. In fact, let me stop sharing this and move to the working notes. Okay, so the name of this company is Abakaliki PLC. All right, the name of the company is Abakaliki PLC. So I will come here, solution to illustration number, what is that? Number 12. So Abakaliki PLC. I want to calculate cost of equity. Whenever you want to calculate WACC, you can't just jump to calculating WACC. You need to start from step 1 up to step 4. Okay? So I want, because every company must have ordinary share capital. So I would then say, number 1, calculating cost of equity. Denoted as KE. So at this point, I need to ask myself, what kind of cost of equity? Is it cost of equity using dividend valuation model, okay, capital asset pricing model, or Miller and Modigliani? And I told you, the dividend valuation model will be used if information on dividend and then share price are given. So according to this question, the examiner has given us share price. We're also given dividend information, which means that we are supposed to use dividend valuation model. So using dividend valuation model, before I put down the formula that I'm going to use to calculate my cost of equity, I need to go back to the question to ascertain whether dividend will remain constant to perpetuity or dividend will grow. According to the question, we are told that the directors have publicized their view that earnings and dividend will increase by 5% a year into indefinite future. Okay, so the examiner has given us, examiner is so magnanimous in this question by giving us the growth rate of 5%. So if you are given a growth rate of 5%, so the formula I'm going to use to calculate my cost of equity will be different from when there is no growth. So since there is growth, I would then say the current dividend, which is DO, multiplied by 1 plus the growth rate, all divided by XDIV, share price, plus the growth rate. All of this, this thing. All of this, okay, multiply by 100 over 1. So that's the formula that we are going to use since there's growth in dividend payments. So KE KE equal to, I will go back to the question to go and pick DO. DO represents current dividend. G is the growth rate. So let's go to the question and identify the current dividend. So according to the question in the last paragraph, you are told that the ordinary share dividend will be 60,000 naira this year. So examiner has given to us the ordinary dividend to be 60,000 naira in absolute form. Then the share price given to us in the first paragraph, we are told that quoted at 1 naira 17 kobo per share, cum div. That 1 naira 17 kobo is par value. And then dividend share price is given to us par value. But the ordinary share dividend is given as absolute number. So we need to, depending on how we want to calculate our cost of equity, we can decide to use absolute value. If I want to use absolute value, that means I need to convert the par value, the share price of 1 naira 17 kobo. I need to convert it to total market value. Okay. But if I want to use par value all throughout, then I need to convert the dividend of 60,000 naira to dividend per share. So whichever way you do it, you are going to get the same thing. Therefore, let's go and do our working first. I'm going to demonstrate the two for you, then you'll be able to make a choice going forward, whichever one that is more convenient for you. So on the first page, I'm going to have ordinary share capital, cost of equity, cost of preference share. Then the second page will be cost of debt and the WACC. So the third page will be for our workings. So here will be for workings. Working number one, I want to calculate dividend per share. Dividend per share. Okay. So dividend per share is calculated as total dividend divided by number of shares, ordinary shares. Total dividend is 60,000 naira. What's number of ordinary shares? Please go to the question and be giving me the information. What's number of ordinary shares?
500,000.
500,000 shares. Thank you. Here is 500,000. Okay. So what do you have here? 60 divided by 500. Please, you have to participate. This is 12 kobo. 0.12. That's 12 kobo. So dividend per share is 12 kobo. So if I want to use par value to calculate my cost of equity, I will say 0.12 multiplied by growth rate is 5% according to the question. So 1 plus 5% will give us 1.05 divided by X div share price. Examiner has given us cum div share price of 1 naira 17 kobo. So we cannot use you don't use cum div share price to calculate cost of equity. It has to be X div share price. Cum div share price means the share price that include dividend. You don't use that to calculate cost of equity. Rather, it has to be X div share price. X div share price simply means the share price that exclude dividend. Okay, so if the dividend has not been paid, then you need to convert it to X div share price. So this 1 naira 17 kobo is cum div share price. So we need to convert it to X div. So let's go and do our working number 2. Working 2, X div. Share price. So X div share price is calculated as cum div share price minus current dividend. Okay. So the cum div share price is 1 naira 17 kobo. Current dividend is 12 kobo. So X div share price is then equal to 1 naira 5 kobo. Okay. 1 naira 5 kobo is the X div share price. So let's go back there and continue with our cost of equity calculation. So here will be 1.05 plus the growth rate of 5%, all multiplied by 100. over 1. So what do you have there? 0.12 multiplied by 1.05 equal divided by 1.05 equal plus 0.05 equal 17%. So here is 17%. Cost of equity is equal to 17%. Please, if there's anything you don't understand, always ask question before we go too far. So cost of equity is 17%. I will then go to the capital structure again to go and check what other source of finance do we have there. Examiner has given to us preference share capital, 6% preference share capital. Therefore, I need to ask myself, what kind of preference share? Is it redeemable preference share or irredeemable preference share? According to the question, examiner just told us that and 100,000 naira of 6% preference shares currently quoted at 40 kobo per share. The preference dividend has just been paid. Okay, so that means that 40 kobo is already ex-div. It's already ex-div share price. So examiner did not mention the redemption date. I told you the only thing that differentiates between redeemable preference share and then irredeemable preference share, redeemable debt and irredeemable debt is if you are given the redemption date. In this particular preference share, examiner did not tell us whether it will be redeemed or whether it is redeemable or irredeemable. So since we are not given the redemption dates, it means that it is irredeemable preference share. So we need to go and calculate cost of irredeemable preference share. The cost of irredeemable preference share represents the ratio of fixed dividend to ex-div share price. The fixed dividend is the nominal rate of the preference share. Nominal rate in this case is 6%. So the nominal value of preference share is always 1 naira. Preference share is always quoted at 1 naira, okay, per share. Okay, that's the nominal value. So to get the fixed dividend that you are going to pay on the preference share, just multiply the rate, the nominal rate on the nominal value. Nominal value is 1 naira. 6% of 1 naira is 6 kobo. Therefore, I will then come here. Number 2, calculating preference share. Calculating. No, okay, this pen is frustrating tonight. Calculating cost of irredeemable. We have been able to establish that it is irredeemable preference share because the redemption date is not given. Okay, so the cost of irredeemable preference share is calculated as fixed dividend divided by ex-div share price multiplied by 100 over 1.
Hello, sir.
Yes?
Is this calculation meant for this place or where you have the other workings, where we calculated the dividend per share?
No. It's not for here. All
Okay.
right. So the next we want to do now, we need to determine the fixed dividend. Like I mentioned, the fixed dividend you are going to pay, I mean, that the company will pay to the preference shareholders you are going to multiply the nominal rate on the nominal value of the preference share. So nominal value is always 1 naira. Then nominal rate, examiner has given it to us as 6%. Therefore, if I like, I can say 6 over 40. If I like, I can say 0.06 divided by 0.4. Whichever way I do it, I will still get the same thing. So here I can say 0.06. Ex-div share price is 40 kobo because examiner told us that the previous dividend has just been paid. Therefore, multiply by 100 over 1. So 6 divided by 40 equal to 15%. So the cost of irredeemable preference share is 15%. Okay. Now, there's something I want to remember again. You know, I told you, here I use in the cost of equity we computed, I use par value. If I want to use absolute value Okay, if I want to use absolute value, in this case, I can say, for example, let me manage here. Let me use this space. So if I want to use par value, if I want to use absolute value, so I can say cost of equity is equal to, my current dividend is 60,000 naira. Growth rate is 5%. 1 plus 5% is 1.05 divided by my ex-div share price. In this case, I need to go and calculate market value of equity. All right. So I will then go to my working. Even though we are still going to need that. So working number 3, example, I want to calculate market value. Market value of equity is denoted as E. Okay. So since we are given number of shares in the question, I can say number of shares multiplied by XDIV share price. So equity value equal to number of shares 500,000. XDIV share price is 1 naira 5 kobo. So equity value is equal to 525,000. Okay, so now that I have the total market value of equity, so I can go up there and calculate my cost of equity. So here will be 525,000 plus the growth rate of 5%, 0.05. Okay, so using the calculator, I can say 60,000 multiplied by 1.05 equal 63,000 divided by 525,000 equal then plus 0.05 equal to 17%. Here is equal to 17%. So whether I use absolute value or I use par value, we are expected to get the same answer. Okay, we are expected to get the same answer. All right, let's move on. So the last one, number 3. Step number 3 is to calculate cost of redeemable debenture. Okay, calculating costs of redeemable debenture, KD. And I told you, whenever you want to compute cost of redeemable debenture, simply go ahead and calculate internal rate of return. To do that, there are 2 procedures you are expected to carry out. One is to assume 2 discount rates that will produce 2 opposing NPV. Then 2, you calculate the internal rate of return, which is your cost of redeemable debt. It's as simple as that. So let's assume 2 discount rates. Assume 10%. So we are going to use this 10% to compute our NPV. Create a column for year, description of items, cash flows, discount factor. Okay, then we have the present value. So year 0, year 1. I will then go back to the question. When are we going to redeem the preference share? Sorry, the debenture. We are told according to the question that the company has issued 200,000 naira of 10% debenture, which are redeemable at par in 2 years' time, and have a current market value of 105.3%. So this debenture is redeemable in 2 years' time. So if that is the case, it means that the company will pay annual interest for year 1 to 2. Then in the final year, that is the maturity date. The maturity date is in year 2. The principal amount will be redeemed at par. Therefore, here will be the current market value of the debenture Here will be the fixed interest. Then here will be the redemption value. Okay. At 10%, let me introduce. Okay. All right. To manage my handwriting tonight. Pen disappointed me. Don't know what happened. 10%. Okay. So I will then go back to the question, what is the current market value of the debenture? According to the question, the current market value is 105.3%. Forget about the percentage attached to the price of the debenture. So it's 105.3 naira. That is the market value of the debenture. However, examiner has told us in the question that debenture interests are due to be paid in the near future. Debenture interests are due to be paid, which means that the 105.3 is cum int price. You don't use cum int price. It has to be ex int price. So we need to convert the cum int price to ex int price. Okay? So I need to go and calculate the current market value, ex int. Working number 4. Okay, let me just do, let me say the value of the debenture, D. The value of the debenture, which is D, let me create a space, is equal to nominal value multiplied by X int price divided by 100. Okay, so D will then be equal to that. After I've gotten my D, then I will get the total value, total market value, which is equity plus debt. So let me leave that space. So that means I'm going to work in number 4 on the next page. So I want to calculate X int price. X int interest price. So the X int price is computed as cum int price, cum int price minus the interest. That is not looking good tonight. We have to manage. So the cum int price is 105.3 minus the interest that the company will pay is the coupon rate attached to the value of the debenture. The coupon rate in this case is 10% debenture, which are redeemable at par in 2 years' time. So that 10% is the coupon rate, is the interest rate. All right, so minus 10. Forget about the percentage because debt is always quoted at 100 naira per unit. So forget about the percentage behind the 10. Just put 10. So A is equal to 95.3. So the X int price is 95 naira 3 kobo. Okay. So let's go up there. Here is, you can see instead of using 105.3, it has to be 95 because that 105.3 included interest. You don't use the price that include interest. It has to be the price that exclude interest. That's why we went to adjust the 105 and we got 95.3. That's the X int price. For year 0, here is 1 multiplied by 95, it gives us 95.3 at 10%. So now, for year 1 to 2, the company is expected to pay fixed interest. So I will then go back to the question. the interest rate is 10%. So the company, if there is no tax, the company will pay that 10%. But in the question, are we given tax rate? Yes, examiner has given us tax rate of 40%. Okay, you can see examiner just told us that the company tax rate is 40%. So it means that because examiner did not tell you that whether this tax will be paid in the current year or in arrears. Whenever examiner is silent as to when the tax will be paid, it means that the tax will be paid in the current year. So, and then, so in this case, this is very cheap and straightforward. For those of you that have, the golden book, you see that this same question was twisted to make it more complex. In that one, in the golden book, the tax is payable 1 year in arrears. So when tax is payable 1 year in arrears, how do you treat your fixed interest? So that's the examples you have in the golden book. Not only that, in the golden book, both all the returns associated with this with the capital structure are in arrears. I mean, are yet to be paid. The interest on the debenture are yet to be paid. The fixed dividend is not yet paid. The ordinary dividend is not paid. So, and then even the growth rate you have in the golden book, the growth rate you have in the golden book is not given to you. You are given information on Gordon growth, how to calculate Gordon growth rates. So that's the information you have there to calculate your growth rate. So, but in this particular question that we are solving, growth rate is 5%. So I twisted that question so that to make it more complex, how you can surpass or how you can treat similar question in the future. Okay, but let's move on. So we want to calculate according to the question, the interest rate, the tax rate given to us is 40%. The coupon rate, the interest rate is 10%. So let's go and adjust for tax. Remember what I told you. Debt has tax deductibility benefits. So when a company finances its operation with debt, it's expected that the company will pay a cheaper cost on the debt. Okay, so working number 5. I want to calculate post-tax interest. Post-tax interest is the same thing as after tax, which is calculated as interest multiplied by 1 minus tax rates. So interest rate as given to us is 10%. Forget about the percentage. Tax rate given to us is 40%. So 1 minus 40% will give us 0.6. Therefore, the post-tax interest is 6. Post-tax interest is 6. So instead of us to use 10, instead of the company to pay 10, the company will only pay 6. You can see that's why we said that debt is a cheaper source of finance because of tax deductibility benefits. So let's go up there and put it in the formula or in our table. Here is 6. Then I need to ask myself from the question, how are we going to redeem this debenture? Examiner has told us that it will redeem at par. And you know that debt is always quoted at 100 naira per unit. So here will be equal to 100 naira. Therefore, I need to calculate annuity factor of year 1 to 2 at 10%. This will give me 1.736. All of you, you know how to calculate annuity factor. Please, if you don't know, let me know so that I can bring out the formula for you. Then discount factor at 10% for year 2, this will give us 0.826. Okay, let me write this. 736. Okay, then. So here is 82.6. Then 1.736 multiplied by 6 equal, that's 10.4. Here is 10.4. So 10.4 plus 82.6. That's 9. Oh,
minus 2.25.
minus 2.3. Okay, here is minus 2.3. Okay, because 10.4 plus 82.6, that's a 93. 93 minus 95.3, that's minus 2.3. So we assume 10%, we got a negative NPV of 2.3. Let's assume a lower discount rate that will give us a positive NPV. So let's assume 5%.
5%.
Yeah. Okay. Somebody should give me an annuity factor of year 1 to 2 at 5%.
1.8544.
1.8.
544.
Okay. This one is frustrating. 1.855, right? Is it?
1.8594. 8594. 859.
859. 859. Okay.
Yes.
Okay then. What about discount factor for year 2?
0.907.
Okay, 0.907. Here will be 90.7. Then 6 multiplied by 1.859 equal
11.16.
11.2. Yeah, 11.2. 11.2. 11.2 plus 90.7 minus 95.3. So what do we have there? 11.2 plus
6.56.
90.7. Okay. 6.6. Here is 6.6 positive. So we assume 5%, we got a positive NPV of 6.6. We assume a 10%, we got a negative NPV of 2.3. Now we have a conflicting, we have two opposing NPV. We can then proceed to calculate the cost of redeemable debenture. So KD, cost of redeemable debenture, which is the same thing as internal rate of return, is calculated as the lower discount rates plus NPV of the lower divided by NPV of the lower plus NPV of the higher, all multiplied by higher minus the lower discount rates. So we assume 5%. 5% is lower. 5 plus NPV of that 5 is 6.6 divided by 6.6 plus NPV of the higher 2.3. All of this multiplied by higher of 10 minus lower of 5. Okay, so final answer. I would then say 6.6 divided by 8.9 divided by 8.9 equal, multiplied by difference between 10 and 5, which is 5, equal, plus 5, equal, that's 8.71. Here is 8.71%, approximately 9%. So the cost of redeemable debenture is 9%. So we have calculated cost of equity to be 17%, cost of preference share to be 15%, and now cost of debenture to be 9%. Finally, we need to calculate cost of weighted average cost of capital. So step number 4, calculating weighted average cost of capital, denoted as KW. Okay, So since we have the three of them in the capital structure, therefore, the WACC is computed as equity value divided by equity plus preference plus debt, okay, multiplied by cost of equity plus value of preference share over equity plus debt, equity plus preference plus debt, multiplied by cost of preference share plus the debt value over equity plus preference plus debt multiplied by cost of debt 1 minus tax. Okay, so KW, I need to go and calculate market value of equity. We have calculated market value of equity to be 525,000. Okay, here is 525,000 divided by total market value. So let's complete it. I need to calculate value of preference share and value of the debt. So since we have the three of them, so this one will come much later. So let me first of all determine the value of the debenture. Nominal value of the debenture. I will then go to the balance sheet. For the debenture is 200,000 naira. That's the nominal value. So here will be 200,000 naira multiplied by X int price. We have calculated X int price before to be equal to X int price is 95.3 naira. Okay, 95.3 naira. Here is 95.3 divided by 100 naira. So what do you have there? 0.953 multiplied by 200,000. That's 190,600. So the market value of the debenture is 190,600 naira. I need to calculate the market value of the preference share as well. Please remember what I said. If there's anything you don't understand, please ask question. Ask question. So market value of preference share is calculated as number of shares. I will go back before I put down the formula. I need to check. Am I given number of preference shares or I'm given share capital? According to the question, examiner gave us the share capital for the preference share. So my formula will change. So it's no more number of shares. Here will be share capital divided by nominal price multiplied by XDIV, share price. So P, share capital is 100,000 naira. Nominal price is 1 naira. XDIV share price is 40 kobo. So this will give us 40,000 naira. So the market value of the preference share is 40 naira. So I need to calculate the total market value, which is value of equity plus value of preference share plus value of the debenture equal to 525 because of space. Let me manage here plus 40,000 plus 190,600. What do you have there? When you add it together, what do you get? Plus 40,000 plus
755,600.
755,600. Thank you. The total market value is 755,600. So that's that. So let's go up there. Let me rewrite this. Hopefully in my next class, I would have resolved this pen issue. Okay. So the total value is 755,600. Okay. Multiplied by cost of equity, we got 17%. Plus the value of the preference share is 40,000. Total value is 755,600. cost of preference share is 15%, we calculated, plus the value of the debenture is 190,600 divided by total value of 755,600 multiplied by after-tax cost of debt. We got 9%. Please, there's no need for you to come and put 1 minus tax again. We've already deducted tax before we arrive at 9%. Remember, when we are calculating X-int price, okay, when we are calculating post-tax interest, this is the post-tax interest. We've already adjusted for tax. So you don't need to go and adjust for tax again from your WACC formula. Because when you do that, that means you are double dipping. You are treating tax twice. So don't do that. Okay, W equal. So I will say 525,000 divided by 755,600 equal, multiplied by 17 equal, that's 11.81% plus 40,000 divided by 755,600 multiplied by 15. That's 0.79. 0.79% plus 190,600 divided by 755,600 multiplied by 9 equal 2.27. 2.27%. Therefore, our WACC is equal to 11.81 plus 0.79 plus 2.27 equal to 14.87. Here is 14.87%. So approximately here is a 15%. That's the WACC. So the WACC of Abakaliki is approximately 15%. Okay. If I don't want to use formula, I can use table. I can use tabular method. I will get the same thing. Say, for example, I want to use tabular method. I will just say the type of
Sorry,
the
sir.
security. Yes?
Please, sir, how did you get the market value of equity?
850. I don't have 850 here. Which one?
The
To take
52500
equity.
market value of equity.
Okay, market, we've calculated it. See the working for market value here. Equity is 525. Number of
Okay,
share
sir.
multiplied by X div share price. All right.
Okay, sir.
So if I want to use the tabular method, I will create a column for types of the security. In this case, we have equity, we have preference share, then we have the debenture. So we are going to have total. Then the market value we have computed. Here is 525. Here is 40,000. Here is 190,600. The total is 755,600. Okay. Then after total, market value, we are going to create a column for proportion. You can call it proportion or cost of capital, cost of individual capital. So equity, we calculated 17%, 0.17. For the preference share, we calculated 15%. For the debenture, we calculated 9%. Okay, let me rewrite that. 0.09. Then, of course, we are going to create a column for hash total. So to get the hash total, just multiply the value with the proportion. So in this case, 525 525,000 multiplied by 0.17 equal to 89,250. Again, 40,000 multiplied by 0.15, 6,000. Then 190,600 multiplied by 0.09, 17,154. Add it up, plus 6,000 plus 89,250 equal 112,404. 112,404. 404. So to now get the work, there's no space down there. Let me just manage it. To now get the work, KW will then be equal to hash total divided by total market value multiplied by 100 over 1. So the hash total is 112,404 divided by 755,600 multiplied by 100 over 1, which is equal to divided by 755,600. That's 14.87, whatever, multiplied by 100. That's 14.88%. Here is 14.88%. So approximately it is 15%. So whether you use formula or you use tabular method, you are going to get the same answer. This is alternative solution. But get used to the formula, because as you proceed, going to the project specific or Wakuka, we are going to be using the formula. So that is the end of the question. Let me know if you have any question for me before we move to another illustration. Okay. If there is no further question, then let's move to another illustration. I'll stop sharing this. Okay. Yes, somebody should read illustration number 13 for us. Illustration number 13, please. Who is reading it? Yes.
The following figures have been extracted from the most recent account of Equity PLC. Balance sheet as at 30th June 2015. Non-current assets, investments, current asset liabilities. Ordinary share capital authorized at 4 million naira shares of 1 naira nominal value. Summary of dividends. The current 1st July 2015, the current market value of Equity PLC ordinary shares is 3.27 kobo. That's 3 naira 27 kobo per share cum div. An annual dividend of 810 naira. 810,000 is due for payment shortly. The debentures are redeemable at par in 10 years' time. Their current market value is 77.10% naira. Annual interest has just been paid on the debentures. There are no issues or redemptions of ordinary share or debenture during the past 5 years. The current rate of corporation tax is 30%. Required: calculate the cost of capital which Equity PLC should you use as a discount rate when appraising their new investment opportunities? Discuss any difficulties and uncertainties in your estimates.
Thank you. Yes, that is the question. Examiner wants us to calculate the cost of capital, which equity PLC should use as a discount rate when appraising new investment opportunity. So like I said, whenever you are asked to calculate cost of capital, you must determine which cost of capital. Okay, is it traditional cost of capital? Is it project specific? Is it WACOCA? So you must establish that. But because in the question, examiner has given us information of capital structure. In the capital structure, we have ordinary share capital. We also have a debenture. So meaning that we are supposed to use traditional WACC to calculate. Okay, we use traditional method to calculate our WACC. So let me stop sharing this and then move to the working notes. Okay. So the name of this company, this is illustration number 13. Yeah. Equity PLC. Solution to illustration 13. Equity PLC. Now, in the question, we want to calculate weighted average cost of capital using traditional method. So we go straight to the balance sheets, to the capital structure of the company. We are given ordinary share capital. It means we have to calculate cost of equity. We're also given debenture. That means we have to calculate cost of debenture. Therefore, when you want to calculate your cost of equity, you need to ask yourself, what kind of cost of equity? Is it cost of equity using dividend valuation model? Is it cost of equity using capitalized pricing model, or the one that you are going to compute using Miller and Modigliani? According to the question, examiner has given us information on dividend as well as the share price. In that case, we're expected to use the dividend valuation model. So without wasting time on this, I would then say number one, calculating cost of equity, okay, denoted as KE. Please don't go and be writing Center of Excellence, COE, on the day of your exam, please. You have to write it out in full, cost of equity. That's what I mean by COE, because examiner may think that you are writing Center of Excellence, okay? So I then need to put down my formula, KE equal to, before I put down the formula, I need to go back to the question and check if we are given, if dividend will grow, if we are given growth rate. The examiner did not give us growth rate in the question. There is nowhere in the question where examiner has given us growth rate, but examiner has told us information on, has given us information on dividend. When you look at summary of profit and dividend, you will see that dividend has grown from 2011, between 2011 and 2015, dividend has grown from 620,000 naira to 810,000 naira. So even though examiner did not give us growth rates, but examiner has given us information to calculate the growth rate. And I told you when you want to calculate growth rates, there are two methods that you can use to calculate the growth rate. You can either use historical pattern of dividend payment or you use the Gordon growth model. If you are given the history of dividend paid, then in that case, you are supposed to use averaging method or historical pattern of dividend payment or extrapolation method, whatever you want to call it. Again, if in the question you are given information on earnings and as well as a capital employed, then you are supposed to use the Gordon growth. But the information given to us in this question, we are given the history of dividend paid between 2011 and 2015. In that case, we are supposed to use the historical pattern of dividend payment. So since we have found information that we have identified from the question that dividend will grow, therefore, my formula would then be the current dividend multiplied by 1 plus the growth rate divided by xdiv share price plus the growth rate. All of this multiplied by 100 over 1. So I need to go and calculate the current dividend. According to the question, the current dividend given to us is 810,000 naira. So I can decide to use absolute number. I can decide to use par value. Whichever one I want to use, I will get the same answer. What is important is that you need to know what you are doing at a particular point in time. So say, for example, I want to use absolute number. In that case, I would then say the current dividend, which is 810,000. I need to go and calculate my growth rates. So this will be for cost of equity, cost of debt plus the WACC. Then my working will be from here. Working number 1, I want to calculate value of equity. I want to calculate market value. Okay, before I get the market value, I need to first of all determine whether dividend has been paid or not. Examiner has told us that the 3 naira 25 ordinary shares is 3 naira 27 kobo per share, cum div. So I need to calculate ex-div share price first. Okay, I need to calculate ex-div share price. Which is calculated as cum div share price minus the current dividend. The cum div share price is 3 naira 27 kobo. Here is 3.27 minus current dividend. So I need to calculate dividend per share, working number 2. Dividend per share. You see the way I'm putting it, because you must know what to do at a particular point in time. Dividend per share. DPS. So DPS is equal to total dividend divided by number of ordinary shares. Total dividend, according to the question, is 810,000. That's the current year dividend. Number of shares. Let's go back to the question. What's number of ordinary shares? 3 million
1 million.
shares. 3 million shares. So divided by 3 million. So what do you have? 810 divided by 3,000. That's 27 kobo. Dividend per share is 27 kobo. So I can then say minus 0.27 equal to 3 naira. So ex-div share price is 3 naira. Okay. So now that I've calculated the ex-div share price, I can then proceed to calculate the market value of equity, working number 3. Market value. Okay. For equity equal to number of shares multiplied by ex-div share price. Number of shares is 3 million. We have 3 million shares multiplied by ex-div share price is 3 naira. So value of equity equal to 9 million naira. That's the market value of equity. Let me calculate market value of debts of the debenture once and for all, which is nominal value multiplied by X int price. Okay. So I will go back to the question. What's the nominal value of the debenture? The nominal value of the debenture, that is the value you have in the balance sheet, is 1.3 million naira. here is 1.3 million multiplied by X int price. Let's go back to the question. Has debenture interest been paid? Examiner told us that the debenture in the last paragraph, we are told that annual interest, annual interest has just been paid on the debenture. So what that means is that the current market price of the debenture of 77.1 is X int price. So I don't need to make any adjustments. So here is 77.1 divided by 100 naira. So what do we have there? So we have 0.7710 multiplied by 1.3 million. That's 1,02,300 naira. 1,02,300. That's the market value of the debenture. So the total market value will be for equity plus debt alone. There's no preference share in the question. So here is 9 million plus 1,02,300. 2,300. Two, three. Let me write this one to plus, not 7. There's 1. Okay, so the total value will then be equal to 10 million naira, 2,300. So I'm done with some of the calculations of some of the workings. So I can then proceed with my cost of equity. So the growth, okay, we've not calculated growth rates. So let's go back there, because I'm going to need that growth rate. Working number 4. Working number 4, growth rates. G, using historical pattern of dividend payments. Using historical pattern of dividend payments, growth is calculated as n minus 1 divided by current year dividend divided by dividend paid in the first year, all minus 1. Okay, we only use this formula if the history of dividend paid across all the relevant years are given. That's when you use this formula, okay, which is equal to, from 2011 to 2015, how many years is that? That's 5 years.
4.
So that'll be 5 minus 1. 5 minus 1 divided by the current year dividend is 810,000 divided by dividend paid in the first year, 620, all minus 1. So mathematically, I can say G is equal to 810,000, 810 divided by 620 raised to power 5 minus 1 is 4. So raised to power 1 over 4, all minus 1 equal. So bring out your calculator. 1 over 4 is 0.25. Therefore, 810 divided by 620 equal raised to power 0.25 equal multiplied by 100%. Sorry, minus 1 first. Minus 1.
That's 6.9%.
That's 7%, approximately 7%. Okay, so the growth rate is approximately 7%. So with this, I can then proceed with my cost of equity calculation. So growth rate is 7%. 1 plus 7% will give us 1.07 divided by, since we are using absolute number, The market value of equity is 9 million naira we computed, plus the growth rate of 7%, all multiplied by 100 over 1. So KE is equal to 810,000. Let me cancel that. 810,000 multiplied by 1.07 equal divided by 9 million equal plus 0.07 equal multiplied by 100 equal, that's 16.63%. 16.63%. So cost of equity is approximately 17%. Okay, cost of equity is approximately 17%. Therefore, we need to calculate cost of the redeemable debenture. Number 2, calculating cost of redeemable debenture, KD. So we are using internal rate of, we are calculating internal rate of return. So I would then say assume 10%. So use that 10% to compute NPV. Item, cash flow, discount factor, then the present value. Year 0, I will go back to the question, what's the maturity date of this debenture? We are told that there are no issues or redemption of ordinary share or debenture during the past 5 years. So we are told that the debenture are redeemable at par in 10 years' time. All right. So the debentures are redeemable at par in 10 years' time. So which means that the company will pay annual fixed interest from year 1 to 10. So year 1 to 10, at the final year, it will be redeemed. This is the current market value of the debenture. This is fixed interest. And then this is the redemption value. Okay, so the current market value is 77.10 because examiner told us that debenture interest has been paid. So there is no need for us to make adjustment on this 77.10. Then the fixed interest, I will go back to the question, what's the coupon rate on the debenture? The coupon rate on the debenture is 7%, 7% debenture. So are we the one tax rate in the question? Yes, examiner has given us tax rate of 30%. So since we are given tax rate of 30%, I cannot use that 7% interest rate. I need to go and calculate after tax cost of debt. So that will take us to working number 5. Post-tax interest, which is equal to interest multiplied by 1 minus tax. Interest is 7%. Tax rate is 30%. So we are supposed to account for 70%. So here will be 4.9. Okay. That's our after-tax cost of debt is 4.9. So instead of company to pay 7, the company will only pay 4.9 because of tax benefits. So I would then call me a 4.9. Then redemption. How are we going to redeem the debenture? Examiner told us at par. At par means at 100 naira. Okay. So we're assuming 10%, starting from 10%. Here is 1. Somebody should give me annuity factor of year 1 to 10 at 10%. Yes.
6.144.
6.144,145.
Okay, I didn't approximate.
Is it? Yes. So the three decimal place. 6.145. Therefore, here will be 39 rounding. Of course, here is at 10%. At 10%. Here is 77.10. Then 4.9. 4.9 multiplied by 6.145. 30.1. 30.11. Here is 30.11. Then here is 38.6. Therefore, let's get the NPV for that. So 30.11 plus 38.6. What do you have there? Final answer. What do you have as your NPV?
8.39.
8.39. Here is 8.39. Negative. So we assume 10%, we got a negative NPV. Let's assume a lower discount rate that will produce a positive NPV. Let me complete my table first. Okay. All right. So let's assume 5%. Okay. So somebody should give me an annuity factor of 5% at 5% for year 1 to 10. Yeah. Annuity factor
7.72.
7.72 what? Like it's 2 decimal, 3 decimal place. Yeah.
7.7217.
Okay,
7217.
7217. 721. 722. So here is 0.247. Okay. So here will be 24.7. Then the other one, 4.9 multiplied by 7.722. Sorry, 722. That's 37.84. Here is 37. This is not correct. So I've done something wrong.
The discount
37.84.
rate at 5% is wrong.
Yes, that's what I noticed that too. It should be higher than the one of 10.
0.6139.
Thank you. 0.61. Did you say 0.6139?
Yeah.
Now 0.614. So here will be 61.4. So here is 77.10. Therefore, our NPV would then be equal to plus 61.4 equal minus 77.1 equal. That's 22.14. Here is 22.14 positive. So we assume 5%, we got a positive NPV. We also assume a higher discount rate of 10, we got a negative NPV. Therefore, the cost of redeemable debenture will then be equal to the lower discount rate of 5 plus NPV of the 5, which is 22.14, divided by 22.14 plus NPV of the higher 8.39. All of this multiplied by higher discount rate minus lower discount rate. Final answer 22.14 plus 8.39 equal 30.53. So 22.14 divided by 30 point, did I say 30.4? 30 point, what did I say it is? 30.53.
30.53.
53. Okay. So equal multiply by 5 equal plus 5 equal 8.63. Here is
Yes,
8.63.
8.65.
No, 8.63. That's 8.63. Approximately, that's 9%. So cost of redeemable debenture is approximately 9%. KD is approximately 9%. So finally, working number 3, we need to calculate WACC. Calculating WACC. So using the formula, equity value, we have already calculated equity value, but let me just put down the formula. E over E plus D. There is no preference share multiplied by cost of equity. Value of the debenture over equity plus value of debt multiplied by after tax cost of debt. Okay, if you have adjusted for tax previously, you can always ignore 1 minus T in the formula so that you don't make mistake. If you know that you have adjusted for tax when you are calculating the cost of debt. Okay. So according to our workings, value of equity is 9 million naira. Value of the debenture is 1,02,300. Okay. Here is 9 million divided by total value of 10 million, 2,300. Multiplied by cost of debt. Sorry, cost of equity we computed is I think 17%. Yes. Here is 17%. Okay. Plus market value of the debenture 1,02,300 divided by total value 10,02,300 multiplied by after tax cost of debt, we got 9%. Okay, so the WACC will then be equal to 9 million divided by 10,02,300 multiplied by 17 equal, okay, let me do that again. 9 million divided by 10,02,300 2,300, okay, equal multiply by 17 equal, that's 15.30, 15.30% plus the other side, which is 1,02,300 divided by 10,002,300. Almost 0. 300 equal, then multiply by 9 equal 0.90. Here is 0.90%. So when you add it up together, our work is equal to 15.3 plus 0.9 equal to 16.2%. 16.2%. So approximately the work is 16%. That's it. That is how to calculate weighted average cost of capital using traditional method. Let me know if you have any question for me before we proceed. Okay. Any questions so far? All right. So basically, this is how to calculate weighted average cost of capital. Let me stop sharing this. Let me see if I can have one more illustration or just go straight to project-specific cost of capital.
Hello, sir.
Yes.
Sorry, at least the question say maybe either we should advise, but with this calculation, is it okay? But or we're supposed to put some?
You have to advise. Just say that Equity PLC should, is it Equity PLC is the name of the company? Let me see. Yes, you just say
Yeah.
Equity PLC should use, what did we get? We got 16%. Equity PLC should use 15% to appraise its investment opportunity. That's all. That's the advice. Now, I want to see if I can solve one more illustration. Let me see. Let's go to project specific. Let me see this particular scenario. Question on Toyota. Okay, let's solve illustration number 10, a different scenario where you are not given dividend. Okay, so somebody should read illustration number 10, please. Yes, who is helping us? Some of you have disappeared. Good. Yes. Chiamaka, please read for us. Chiamaka. Are you still there? Chiamaka. Christiana. Somebody should read for us, please.
Toyota Limited and Honda Limited are two companies in the same chemical industry. While Toyota has automated its operations, Honda is just in the processes of doing so. Both, however, use good quality materials in their production processes, and their products are well accepted in the market. For the year ending 31st December 2012, each company had net turnover of 4,800,000. The actual kegs of chemicals sold there were Toyota 320,000 and Honda 300,000. Other operating statistics for each company for 2012 is as follows. Cost of direct materials consumed 1,800,000. Okay, let me skip this.
Leave those ones.
The two companies summarized balance sheets as at 31st December 2012 are as follows. Capital, one naira ordinary shares at 1 million naira.
Leave those ones.
Then,
Required.
okay, sir. Required. Assuming that the market
I didn't get that. I can't hear you again.
Network at his side.
Oh, okay. Yes, required. Assuming that the market value of preference shares and debenture are the same as their book values, you are required to advise the management of the two companies on the appropriate cost of capital for the for the purposes of project evaluation. So we want to calculate the uh, cost of capital for the two companies for both Toyota and then under PLC. So if that is the case, how do you calculate your cost of capital? This is traditional weighted average cost of capital because we are given information on capital structure for both companies. We are given information on capital structure. I can see ordinary share capital for both companies, preference share orders for Toyota only, then the debenture for the two companies. So that's the capital structure. So in that case, we are supposed to use traditional method to calculate the WACC. So using traditional method, I need to calculate cost of equity because there is ordinary share capital. I need to calculate cost of preference share for Toyota only. Under PLC does not have preference share. Then I will also calculate cost of debenture for both companies. Then step 4 for Toyota will then be calculating the weighted average cost of capital. So without wasting time, I want to calculate cost of equity. How do I calculate the cost of equity? Examiner did not give me information. Well, of course, our examiner told us that ordinary dividend payout ratio. Examiner only gave us the payout ratio. We're also given the current market price of the ordinary share to be 3.45 kobo for Toyota, then 70 kobo for Honda. So information on dividend is not given. Okay, dividend is not given, but information to calculate dividend is given to us because examiner mentioned that the ordinary dividend payout ratio is 50% each for both companies. So in this case, I need to calculate for me to be, this is what examiner is trying to tell you is that you can see from the scenario printed in this question, the earnings is not given to you. That is, profit after tax is not given to you. You know, in the profit or loss accounts, the primary, the top line item is the revenue. After revenue, you charge your direct cost. You have your operating expenses. You have your profit before interest and tax. You charge interest expense. You have your profit before tax. You charge your tax. You have your profit after tax. From your profit after tax, you first of all pay preference dividend, then the balance that is attributable to the owners. From that balance, you pay the ordinary dividend. This is what you are supposed to do in this question, because in this question, examiner did not give you profit after tax. You are not given information, you are not given dividend, but information to calculate dividend is given to you. So this is a different scenario entirely. Let's work it together. So I will stop sharing this and move to the working notes. Okay. This is solution to illustration number for illustration number 10. Solution to illustration 10. Toyota PLC and Honda PLC. So first thing first, I need to work out, because examiner did not give me dividend, I need to determine the amount attributable to ordinary dividend before I can do anything. Therefore, I will start from here. I can go and do my working somewhere. This will be for that. That is for cost of equity, cost of preference share, cost of debt, weighted average cost of capital. Let's say our working will start from here. Let our working start from here. Okay. Right. Okay. Like I said, let me re-estimate that. This is for 2. So let the working start from here. Working number 1. I want to determine dividend. Calculating ordinary dividend. Or just simply say income statements. Ordinary dividend. Say calculate ordinary dividend, or you say ordinary, or you say income statements. Okay, so we have Toyota first. We have Toyota, then we have Honda. We can restrict our numbers to thousands to save time. So let's go back to the question. We want to determine profit after, it is from profit after tax that we are going to get the dividend. So first thing first, when in your POL, in your profit or loss account, the first item will be your revenue. In this question, it is called turnover. And then according to the question, we are told that both companies earn a turnover of 4.8 million. Here is 4,800, 4,800. From the turnover, you are going to less all the direct costs. So forget about all those classifications, direct costs, operating expense, just deduct all the relevant costs and move on from there. So I'll go back to the question. The first item is cost of direct material consumed. So I have direct material cost, direct material under Toyota is 1.8, then 1950. 1.8. Be calling the line item for me so that it will be faster. What's the next one after direct material? Yes,
Direct labor,
direct labor. How much is direct labor?
1,200 and 450.
1,200 and 450. After that, which one next?
Production overheads,
Production overhead. How much is it?
400 and 1,000.
400 and 1,000. Next item,
Admin and selling expenses,
admin and selling. How much is it?
420, 420.
420, 420. After that, which one?
Interest on debenture.
That will
100,
come much later.
180.
So let's find it.
Yeah.
So like, the interest will come later. We
Okay.
want to determine
Yeah.
profit before interest and tax. So
Yeah.
yeah.
We're done.
What do you have here? Let me do for under 48 minus 1950 minus 450. Give me for Toyota 450 minus 1420.
980.
Here is
Toyota.
980. Toyota is also 980. This represents profits before interest and tax. So immediately after profit before interest and tax, we need to charge tax. According to the question, the examiner told us tax is 30% for both companies. So at 30%. So what's 30% of 980? 30% of 980. 294.
294.
294. Here is also 294. So what's the difference? Sorry, we need to first of all charge interest expense. I thought I've charged that. So after profit before interest and tax, you need to charge interest. How much is interest?
That is before the tax.
Yes. Interest is 100,000, then
100,000. 180.
100,000, then 180. So here is 880. Here is 800. This is profits before tax. Then you now charge tax at 30%. So what's 30% of 880? Yeah.
264.
264.
264 minus 880 will give us 5. That's 516. Am I correct?
616.
Sorry, 616. Yes, 616. Okay. Then what's 30% of 800?
240.
240 minus 800,
560.
560. This represents profits after tax. So immediately after profit after tax, you are supposed to pay preference dividend. You have to pay preference dividend before ordinary dividend is paid. So for Toyota, there's a preference dividend, that's a preference share. So here is preference dividend. So I will go back to the question. For the preference share, we have 10% preference share for Toyota. Therefore, 10% of the nominal value of the preference share. Nominal value is 400,000 naira. Okay, the nominal value of the preference share is 400,000. So 10% of 400,000 should be 40,000 naira. So here it will be 400,000 because of space. Let me adjust that. Preference dividend equal to 400,000 multiplied by 10%, which is 40,000. So there is no preference dividend for under. So here it will be 560. Then 616 minus 400, that's 576. Okay, so this represents the profit attributable to owners. Profits attributable to ordinary share, to equity holders, or just say to owners. So it is from this you are going to pay ordinary dividend. So examiner now told you that the dividend payout ratio, the ordinary dividend payout ratio is 50% each. So dividend at 50%. So what's 50% of 576? That's
288.
288.
288. So here will be what? 280. All right. So here is 288. Here is a 280. So this is retained earnings, part of the profit that is retained in the business. Retained earnings. We don't need that. What we are looking for, we have found it. It is this dividend that we are looking for. And that's what the examiner hidden in the question. You are not given the dividend, and then now we have gotten it. So now that you have the dividend, so just follow the normal procedures of calculating your cost of equity. So the next thing I want to do now is to calculate cost of equity. Number one, so I would then say calculating cost of equity. Of course, there is dividend, there is share capital, sorry, there is a share price. So we are using dividend valuation. Therefore, I would then say there is no growth in the question. The examiner did not give us growth, and we don't have information on how to calculate growth. So it is assumed that dividend will remain constant for the foreseeable future. So if that is the case, since there is no growth, therefore the current dividend divided by xdiv share price multiplied by 100 over 1. So for Toyota, I would then, the ordinary dividend for Toyota is 288,000. 288,000 is the ordinary dividend divided by xdiv share price. According to the question, the examiner told us that you have to assume that the market value of preference shares and debenture are the same as their book value. That is for preference share and debenture. However, according to the question, the current market price of each ordinary share is 3 naira 45 kobo and 70 kobo. Okay, so we are not told whether dividend has been paid or not. So where examiner is silent, you are going to assume that dividend has been paid. Therefore, we don't need to make any adjustment on that. So I need, since I'm using total value method, so I can just come here, the total number of shares for, okay, let me go and do working because of the other one. Okay, so I need to, in this case, since I want to use absolute value to calculate my, I want to use absolute value to calculate my my cost of equity. So I can say dividend divided by market value of equity. Okay, market value of or equity value divided by equity value. So let us go and calculate equity value. Oh, I need to, this one is supposed to be for my workings. It's supposed to be, this page is supposed to be for my workings. I will go and do it up there. Okay, so working number 2. Value, equity value. Calculating equity value. E equal to number of shares multiplied by, according to the question, are we given number of shares? We are given share capital. So in this case, it will be share capital divided by nominal price multiplied by xdiv share price. So for Toyota, the value of equity for Toyota, the number of the share capital is 1 million naira. Here is 1 million naira divided by nominal price of 1 naira multiplied by 3 naira 45 kobo. This will give us 3 million 450,000. That's the market value of equity for Toyota. I will also do for Honda. Value of equity for Honda. Ordinary share capital for Honda is 1 million naira. Then the share price, the nominal price is 25 kobo. So here is 1 million naira divided by 25 kobo, 0.25. XDIV share price is 70 kobo. Therefore,
2.8 million.
that's 2.8 million. Here is 2,800,000. So that's the market value of equity for Honda. So at this point, let's go up there and do the calculation. Okay, so calculating, number one, calculating cost of equity, KE. KE equal to dividend. Since we don't have dividend per share, if you want, you can calculate dividend per share, but we want to use absolute value. So, but yes, total dividend divided by total market value. Total market value of equity multiplied by 100%. Since there is no growth rate, so the total dividend we calculated for Toyota is 288,000 divided by total market value for Toyota is 3,450,000 multiplied by 100 over 1. Sorry, let me put it down. For Toyota, 288,000 divided by 3,450,000 multiplied by 100 over 1. So what do we have here? 288 divided by 3,450, then multiply by 100. This is 8.35%. So approximately 8%. Okay, this is approximately 8%. Then we have Honda. Total dividend for Honda is 280. Is it 280 we got? Let me confirm. 280 or 2. Yes, 280 is the total dividend for Honda. So here is 280,000 divided by market value of equity of Honda, which is 2,800,000 multiplied by 100 over 1. This should be 10%, right? That's 10%. So we have calculated cost of equity for both companies. Then number 2, we need to calculate cost of preference share. I would then say calculating cost of preference share. Only Toyota has preference share. Therefore, KP, before I put down the formula, I need to confirm what kind of preference share is this one. Is it redeemable or irredeemable? Examiner has told us, examiner did not tell us whether it's redeemable or irredeemable because we are not given the redemption date. So it means that the preference share is irredeemable. Okay, and examiner also told us that the market value of preference share and debenture are the same as their book value. That is, the value you have in the balance sheet is the same thing as their market value for both preference share and then the debenture. So the value of preference share you have in the balance sheet is 400,000 naira. Okay, 10%. So I would then say here is fixed dividend divided by total market value of preference share multiplied by 100 over 1. So only Toyota has preference share. So for Toyota, Toyota fixed dividend is 40,000. 40,000 dividend is paid. When you go back to the calculation that we did, the first working, the preference dividend for Toyota is 40,000. See it there. This is the preference dividend, 40,000 naira. So I would then say 40,000 over 400,000. Here is 40,000 divided by total market value. Examiner said that the market value of the preference share is the same thing as their book value, and the book value is 400,000 multiplied by 100 over 1, which is equal to 10%. Okay, so working number 3, calculation we are going to do. We want to calculate cost of debenture. So calculating cost of debenture. What kind of debenture is this one? This should be irredeemable debenture because we are not given the redemption dates. Therefore, cost of irredeemable debenture is calculated as fixed interest. I will go back to the question if I'm given tax rates. Yes, examiner has given us tax rates, so you need to adjust for tax. At all time, whenever you are calculating cost of debt, you must adjust for tax if you are given tax rates. So divided by total market value of the debenture multiplied by 100 over 1. So KD for Toyota, the fixed interest, based on our calculation, the interest expense we paid for Toyota, I think is 180,000. No, 100,000 for Toyota. Interest is 100,000 naira for Toyota, 180,000 for Honda. So here is 100,000 divided by the book value of the debenture. The book value of the debenture, according to the question, is 800,000 naira. An examiner has told us that the market value of the debenture and the preference share is the same thing as their book value. So the book value of the debenture is 800,000 for Toyota divided by 800,000 multiplied by 1 minus tax. Tax rate is 30%, so we are supposed to account for 70%. Multiplied by 100 over 1. So final answer on that, 70,000 divided by 800,000 equal, then multiply by 100. 8.75, that's approximately 9%. That's approximately 9%. Then we do for under. The fixed interest for under is 180,000. Tax rate is 30%, so we have to account for 70%. The book value of the debenture, for under is 1.2 million. That's 1.2 million, which is the same thing as their market value, multiplied by 100 over 1. So 180,000 multiplied by 0.7 divided by 1.2 million multiplied by 100. That's 10.5%, approximately 11%. So we have calculated cost of preference share, cost of debenture, and then cost of equity. The last thing we need to do is to calculate WACC. So number 4, calculating weighted average cost of capital. So KW equal to equity value over equity plus preference plus debt multiplied by cost of equity plus value of preference share divided by total value multiplied by cost of preference share plus value of the debt, equity plus preference plus debt. Okay, cost of debt, 1 minus tax. We've already adjusted for tax, so we don't need to stress ourselves again. So I would then say Toyota, the value of equity for Toyota is 3,450,000 divided by total value of equity. Let me check down there if I can. Value, market value of equity, market value of debts, total market value. Okay, let me do it. Market value of debts, preference share, market value of preference share. Sorry. Market value of preference share. For Toyota, examiner told us that we assume the book value as the market value, which is 400,000 naira. Okay. The market value of the debenture. We also assume the book value as their market value. So for Toyota, it's 800,000 naira. For Honda, it's 1.2 million. So let's get total market value. Total market value will then be equal to value of equity plus value of preference share plus value of debt. So for Toyota, value of equity for Toyota is equal to 3,450,000. Value of preference share is 800. Value of debt, value of preference share is 400. Value of debt is 800. So total value for Toyota is 4,650,000. I think this is 1.2. Yeah, 4 million. Am I on my own?
Yes, you are correct. For Toyota, 4.65 million.
Okay. Then for Honda, value of
4
equity
million.
is 2,800,000. Value of equity is 2,800,000 for Toyota. Okay. Then there is no preference share for Toyota, but there is debt of 1.2 million. So total is for Honda rather. Total is 4 million. So let's go back up there. So here is 4,650,000. Okay. Multiplied by cost of equity we calculated for Toyota. The cost of equity for
8.35%.
is 8%. We calculated
Okay, you've
8%
calculated.
as yes, 8%. Okay. 8% for Toyota multiplied by 8%. Then what do you have here? Sorry, let me rewrite that.
Preference shares.
Let me rewrite that because of space. Multiply by 8%. Then for preference shares, value of preference shares is 400,000 divided by total value 4,650 multiplied by cost of preference share of 10% plus value of the debenture is I think we got 1.2 million. Let me confirm. Value of the debenture is 800,000.
800,000.
800,000. 800,000 divided by 4,650,000 multiplied by cost of the debenture for Toyota 9%.
9%.
Yeah.
X interest.
Yes. 9% already X. Therefore, for Toyota, 3,450 divided by 4,650 equal multiplied by 8 equal 5.94. Here is 5.94% plus 400 divided by 4,650 equal multiplied by 10 equal 0.86, 0.86% plus 800 divided by 4,650 equal multiplied by 9 equal 1.55, 1.55%. Therefore, 5.94 plus
16%.
0.86. Okay. No, it's not up to
16.
plus, it's not up to plus 1.55. That's 8.35. That's 8.35%. The first equity is 5.94 plus 0.86 plus 1.55.
Yeah.
That's 8.3.
86.
That's 8.35. So approximately this is 8%. So the WACC of Toyota is approximately 8%. So let's do for Honda. So for Honda, market value of equity of Honda is I think 2.8. Yes. Market value of
Okay,
equity of
8.3%.
Honda is 2.8. Then the total market value of Honda is 4 million. So 2.8 divided by 4 million. Okay, 2.8 divided by 4 million multiplied by cost of equity of Honda. Cost
10%.
of 10% is the cost of equity of Honda. Okay. Multiply by 10 plus value of the debenture is 1.2 million divided by total of 4 million. Multiply by cost of debt of Honda. Cost of debt of Honda is 11%. Okay, that's 11%. Multiply by 11%. Okay, did we adjust for tax? And that, yes, we did. We adjusted for tax. Okay, so 2,800 divided by 4,000 equal multiply by 10 equal, here is 7% plus the other side 1,2 divided by 4,000 equal multiply by 11 equal 3.3. 3.3%.
10.3%.
This is 10.3%. So approximately the WACC of Honda is approximately 10%. That's end of the question. That's what the examiner wants you to do. You have to calculate, you have to advise the management of the two companies on the appropriate cost of capital for the purpose of project evaluation. In this case, you can just say Toyota PLC should use, what did we get? 8%. Should use 8% and under PLC should apply 10% to appraise or to evaluate their new investment opportunities. That's it. That's the end of the question. That's the end of the question. Let me know if you have any questions so that we can close the class for today.